Hello there, we continue the Trading Academy on topratedforexbrokers.com with one video analysis that will explain to you a basic concept, how to make a profit on the Forex market, or how to make a profit in FX trading. It is not just simply buying or selling something. This is what you know, or this is what attracted you to the Forex market in the first place. The possibility to both buy and sell a currency pair and then to profit from the difference between the entry and the exit price. This is the definition. However, did you know that almost 90% or more of Forex retail traders fail on their first deposit? This is a cruel reality, but most retail traders fail at Forex trading. Various aspects contribute to this terrible statistic, and in the article that comes with this video, we'll point out in around 2,000 words what these reasons are. But here I will explain to you in plain English why most traders fail. It is not the knowledge, as knowledge can be learned. You can simply learn or study for a year or so the ins and outs of Forex trading. To make it in this business, you need something more, and that is to understand your own strengths and weaknesses and what you do with them, or what you can bring to the Forex trading table. Let me explain it to you. This is Euro US dollar, and this is the hourly chart. Let's take a horizontal line and mark the start of this move here, because this is the market's reaction to the Federal Reserve of the United States FOMC statement. This was around 1.5 weeks ago. Because the Federal Reserve was hawkish, it left the door open for another interest rate hike in December this year, and the market took it as hawkish or bullish sign for the dollar. So the market bought the Euro US dollar. Basically, the dollar dropped in the blink of an eye, in an hour actually, from 1.2033, and over the hour, it dropped all the way to 1862 and closed the hour at 1888. Now, if you know, when the FOMC statement comes out, it is after the London sessions closed towards the end of the trading day. The trading day ended somewhere around here, below 119, that's for sure. And that was on a Wednesday. So let's assume that you are bearish on the Euro US dollar for various reasons. For example, one reason to be bearish with the Euro US dollar here is this rising wedge here. Under the technical analysis further in our Trading Academy project, here we will cover the rising and falling wedges and how to interpret them all. This is a beautiful rising wedge on the market, formed on the Euro US dollar ahead of a major US dollar event. So if we are, as technical traders, to have a bias on the Euro US dollar, or on the dollar, ahead of a major economic dollar-driven event, then the bias was that the Euro US dollar would move lower, and hence it will be bullish on the dollar. All we had to do, because this reaction came 1, 2, 3, almost 3.5 candles, or almost 3 hours ahead of the actual release. So for example, we had 3 hours to place a pending order, to sell here at the previous swing. And that means the lower base of the rising wedge was broken. So to sell here, you place a stop loss, and simply go for a very nice risk-reward ratio, or stay on a target derived from a bigger time frame. What can be easier than that? In this case, we went short and we were right with market reaction, but Wednesday closed, then market psychology kicks in. Because just like that, the market pushed high on Thursday, even high on Thursday for the Thursday closing. Come Friday, the previous Friday, it stretched all the way to 80% retrace and so on. You can tell me what you want, but the moment the market retraced more than 61.8 at 80% and stood here for up to 3 hours on a Friday, then your confidence is shaking, and this is the reason why you will fail. You would close on such a move and you won't stay for the target. And if you placed a pending sell stop ahead of the FOMC here, then the market moves 100 pips in your favor, you put a stop loss at break even, and the market comes, gets you out to break even, only to collapse later. Were you right on the overall direction of the dollar? Yes, you were. Did you make any money? No. Why? Because you are unable to control the fear and you put a stop loss at break even in order to protect your account instead of leaving it at the original price. So this was fear. Sometimes it is greed when you try to protect profits and you don't respect the original plan. This is human nature in trading, so you are right in the overall direction and you end up losing it. This kind of market reaction is 80% retracement, sometimes even more, and then the market goes on its way to retail Forex traders failing to make a profit in the FX market. So how do you actually make a profit in the FX market? Respecting yourself, respecting the market, understanding the market, and make sure that you understand market psychology. Make sure you understand high frequency trading and its importance these days in the market. And above all, make sure you understand yourself and that you are able to cope with losses, because this is not a one-way street where you'll have only 100% winners. You must learn to cope with losses, because in this game, losses are part of it. So to sum up, how to make a profit in Forex trading. Knowledge is one thing. Technical and fundamental analysis can be taught, but no one can teach you how to behave like a pro. When you are afraid to put your money on the line, but because you put your money on the line, you are the only one responsible for it. Therefore, risk management and money management have a much heavier say on the overall profitability of a Forex account than the actual knowledge. You'll find out later in this Trading Academy why.